Now, just to start on this slide as we finish the last segment is just looking at that trade balance, because this is where we see that pressure on the export side, as we talked about, against GDP and what the expectations are in Q4, as well as we head into Q1, because we're going to continue to import. There's still a huge amount of products sitting offshore, and that has to onshore, and that's, again, going to keep the import side as exports remain bottlenecked. So that's why that record deficit. Now, does it have to continue to get worse? I don't think so, but it's not going to get much better either when we look at the average over Q4, which is going to be a negative, or as at least a bigger detriment than expectations against Q4 estimates. And that's why it's important when we start looking at, well, earnings revisions. So earnings revisions have gotten back to essentially just at that zero or negative territory, as we're seeing some of this pressure increase on margins as wages go up, as supply chain prices continue to kind of bite. And you're starting to see some of this impact rolling through, and we're going to get more comments in terms of where things are and how these companies expect the market to close out in Q4. So then when you start looking at those leading and lagging indicators, so when you look at the leading economic index and the coincident economic index, another way to look at leading indicators is a relationship to coincident indicators. Ratio is still strong in an expansionary mode, but historically a rolling over has signaled a slowdown in growth, and if deep enough, eventual recession. So that's what we've been seeing, and that's what we've been talking about. It's not so much this huge revision lower, but just you're starting to see those issues creep in, and you're starting to get that rollover as we look forward and see that in that projection. Now, when we start looking at the leading indicators coming from the regional Fed, they have been fairly good in terms of, beating estimates. They're still low, not back to where they were, but again, you're starting to see some of that level off, and that's a positive as we go through October. But remember, that's also what we were expecting. We expected October to be a good month, and then the biggest delta is going to be what happens in November going forward. So then when we start looking at real final sales are in real trouble, netting out the inventories component from GDP, real final sales are expected to contract at negative 1.6% annualized rate in Q3. Historically, that decline was just prior to or in beginning of recession. So when you start looking at those estimates in general on the real final sales, we've actually had real final sales come down. Now, they're not as bad as expectations, but they're still moving in a direction that continues to point to some of those headwinds that is going to offset, again, with those different inventories and what the consumer is going to do, as well as what corporations are going to try to accomplish. And then an indicator exhibiting late cycle behavior is the spread between consumer confidence board, consumer expectations, and present situations. Simply, spread shows consumers are comfortable now, but their outlooks have soured considerably, which again is what we continue to see. And that's where people are looking to say, look, I'm okay right now, so I'm going to buy what I can right now, instead of waiting because I see the inflation, I see the supply chain issues, I'm unsure about what things are going to happen. So I'm going to spend what I can here so I don't have to worry about spending it further down the line. Again, pulling forward some of that growth, which is why we expect 2022 to really miss estimates. And the question is going to be, how good is Q4? And I think November is really going to be that pivotal month to see, did a lot of this get pulled into October? Or are we seeing additional movement through November? Because we still haven't gotten heating prices yet, or heating bills, which I still think is going to be shocking to many as we go into the winter months. And this is just looking at how things are trending. So on the leading economic indicators, average work week is worsening. Unemployment claims are improving. New orders, again, is stable, as we talked about. ISM new orders is improving after weakening. But when you look at new orders, you're starting to see some of that mixed, but again, still fairly stable. Building permits is getting worse. S&P 500 is there. Leading credit index has improved, even though it's coming from a fairly low level. Interest rate spread has actually worsened. This is a little dated. and then consumer expectations have worsened, where then when you look at the payrolls, payrolls have been improving, personal income less transfers, that has been improving, depending on where you're looking. On average, when you average the lowest two and the top two, it is improving, but there's a wide divergence between those two, which again leads to where I see those concerns going into in Q4 for spending, as industrial production kind of stabilizes and real manufacturing and trade continues to improve, just at a slower rate, but still, again, improving. So then when we start looking at PMI, so as we said last week, we expected by last month, we expected U.S. manufacturing to dip down, where we expected it to come below where we were. It missed estimates. Estimates were 60.5, came in at 59.5, but we did expect services to get better. So that just kind of played out here. As you can see, supplier delivery times getting much, much worse. And that has not gotten any better, especially when you look back through the supply chain. But then this is looking at services. So the survey was for 55.2, came in on the actual side at 58.2. But that's positive, and it's positive. But regardless, when you look at prices charged, they exploded. And when you look at the expectations, as we showed in segment 2, the expectations are for prices to continue to go up because of the wages issue, because of these other issues that we've talked about, which again is going to pin this inflation as less than transitory. And then when you start looking on the other side, again, coming back to those leading and coincident indicators, new orders have come down, but they're still positive. And that's important, where when you're looking at where things are, they're trending stable because they're positive, but just down just based on pricing. As you can see, output prices hit a new record, as did input prices hitting a new record. So you're just seeing record numbers across the board, and they're trying to pass through, because when you look at input prices at about 87 and output prices at about 77, companies are going to try to close that gap as much as possible. But this is where we look and we see that hit to margin and some of those underlying problems. And that's when you start looking at the consumer confidence board. Consumer confidence, again, all of them bounced, had a nice little bounce. It was small, but again, just shows some stabilization, not a huge change in just opportunity, but again, just a bit more of a stabilizing entity versus anything else as we head into next month. And then when you look at where that sits, so the survey was for 108, the actual came in at 113.8, so slightly better when you look at consumer confidence. Expectations, again, just kind of bumping along the lows, the pandemic lows. So then, but it's not everybody. And when you look at the spread between high and low income individuals' confidence, still low relative to history and pre-pandemic territory, but hasn't hit those lows that we saw in that peak 2020. So you're still seeing that difference, where people at the top are like, it's not that bad, and then people at the bottom were like, it's tough, and it's getting a bit worse. But you're seeing some of that, again, some of that stability, which is a positive as wages have gone up. And now, even with income, the growth is still negative, but at least there's still some growth to offset, which again is a net positive when you're thinking about that lower income quartile. So then when you start looking at Richmond Manufacturing Index, survey was for 5, actual came in at 12. New orders, there was negative, now it's positive. So you're starting to see some growth, which, as we were talking about in October, that's when, again, you're going to increase as much as you can for that holiday season and try to get in front of it, which is why October is that good month. But we want to know, what does November look like? As raw material inventories continue to go back towards the lows, and vendor lead times reach new records, which again, why you're rushing to do as much as you can in October, because of these two key components. You want to make sure that you have stuff available as you head into the holiday push. And then current prices received moved to a new high, and expected prices received moved to a new all-time high. So again, you're still getting prices moving through. You're still getting, again, this is the inflationary pressure that continues. But when you look at these different backdrops, the leading wage indicator, and you still have wage shortfalls, you still have help wanted signs. So you're going to have to pay those wages, but how do you push that through based on pricing? Which is why we still see inflationary pressures, and it's really going to be driven based on how quickly do these wages go up. And then now Dallas manufacturing survey was for 6, actual came in at 14.6. The manufacturing growth rate of orders also bounced. So again, another positive, all of that being pulled into October. And the questions would be, what does November look like as we go through as we get into the first part of the month and see where things are shaking out. Manufacturing unfilled orders continue to climb as prices received for finished goods reached a new record as, again, prices going up. It's not just one location. It's a U.S. problem. So, when you look at the Philly Fed 6-month forecast unfilled orders, some hints of easing supply chain worries and 6-month outlook for unfilled orders in October. Manufacturing index component plunged to negative 18.1, which is the lowest since 1998. So again, you have some positives, but this is that negative that we've been talking about on that unfilled orders, that inventory issue and this concern, which is pulling forward a lot of production to make sure that it's there in time for the holidays. And then manufacturing new orders again moved up as the Philadelphia Fed Manufacturing Index the expectation was for 25. The actual came in at 23.8. So you had some slowdown, but you have new orders there. It's just that inventory balancing and that labor, which again is keeping some things still in a positive, still in an upward trend, but you're getting an idea of, there's some positive, there's some kind of stable, but there's really no negative, and it's a good thing for October and how Q4 is really kicking off. So then when you look at the Philadelphia Fed manufacturing unfilled orders expected in 6 months, you see how negative it's gotten as prices paid remain at near all-time highs. So when you look at the average Philly Fed ISM equivalent sub-indexes, ISM manufacturing index, it's indicating that ISM should get a bit better in the near term, which is expected just given the leading indicators. But when you project out, you can see that things get a little bit better, as you can see in that leading 10 months and how they drop off, which just really points to what the issues are and how they continue to play out. With a lot of this growth pulled forward, it leaves 2022 very naked for growth and struggling for growth, which is where we see some of that additional risk and something that I don't think the market is pricing in properly at this point in time. So then when you look at hours worked and hourly pay, point to that strong demand, which is, again, you're seeing some of that work week is getting a little bit better depending on where you are. Some of it is going down, some of it's going up. And the reason why it's going down in some spots is because some facilities have to close due to shortages. But that's not because they don't want to work or can't, or they can't work because of inventory, not because of the demand. Demand is there, the inventory isn't there. So there's some separation there. So separate data shows the labor market is tight. The average work week and hourly earnings growth both remain well above pre-pandemic trend as employees work more to maintain output and companies increase pay to attract workers with more pressure coming. But then when you start looking at some of these pressures on the other side, so how is the current percentage of tenants moving out to buy a home? And here you can see that there's been a huge drop off in people leaving to go buy a home. And it just comes down to, well, there's just not a lot of volume available and prices are crazy. So I'm not going to pay that price. So then charts of the day, U.S. rental. So this was an interesting one because I was also on that backdrop where I thought weekly evictions were going to really kind of snap back up. But we really haven't seen that. And there's multiple sides to that. One, a lot of landlords probably made deals with their tenants to, look, we'll figure something out. We'll forgive X, pay this, and you can stay. And then there's a huge backlog in the courts. So there's also a lot of structural problems when you look at how we're going to close that gap. Now, I do think that you'll see this creep higher, but it is going to take time to see that happen. Now, commodities in short supply for the 5 consecutive months. Here you can see that electrical components, hot rolled steel, it's just everything. You're just seeing it across the board. That is going to continue to impact how manufacturing goes and what the pace of that manufacturing looks like. So then when you start looking at the inflation remains the biggest tail risk. So when you start looking at prices, wages, inventories, input costs, raw materials, that's a big issue. And I think this is a funny one because to me it's relevant, especially when you see rent going up at that level, which is why it's becoming a much bigger concern. And this, I think, leads to some of the issues in terms of why people aren't moving and where that inflationary risk is. So as Cornerstone notes, 21% of all new home sales under 300,000. This stat can be cut by market, and some parts of the country have nearly 60% below that threshold. Others, zero. That's still relatively affordable housing in places. So there's places like Louisville, San Antonio, Indianapolis still have homes under 300,000. But look at Baltimore, DC, Denver, New York, San Fran, Sacramento, essentially all of California. There are places where there's no homes under 300,000. That is a huge problem when you think about that disconnect that we've been talking about between home sales and wages, which we'll show in a second. So then when you look at the median sale price of a house is now $404,700. So the average home just continues to go higher, and but yet the Fed is still buying mortgage-backed securities. Why? This is where you get some of those friction points when we talk about GDP growth and how some of this is going to start to cool off. And then those U.S. new home sales, more and more of them are either under construction or not started, which again leads to why we're not seeing those pending new home sales, because people are still waiting for some of that stuff to be built. But you will see construction remain elevated because there's a lot of capacity to close. But this is, I think, the important one when you start looking at wages. So when you look at the purchase-only house price index for the United States, continues to surge higher, and then the average hourly earnings has pivoted up, but obviously not the hockey stick that we've seen for the price of a home. So then when you look at the year-over-year change in average raw material cost per vehicle, again, this is coming back to more in that of inflationary pressure. So you still have those raw material costs that have surged higher and remain elevated. But it's not just the input cost to a vehicle, which is going to keep cars expensive. It's also when you look at not only just used cars and trucks, but beef, bacon, lodging, eggs, furniture, fresh fish and seafood, apples, all of these basic commodities that people need to survive continue to go up, and again leading to that stickiness in that inflationary calc, which is why when you look at the economists have sharply increased their inflation forecasts, but they still come back down as you go through the end of 2022, which is where we start to deviate in terms of what we're seeing, what we're talking about, and what the expectations are in the market. But even with that, and again, because of that, you have to start factoring in, well, maybe inflation does come down as long as you get some of these Fed rate hikes. So now the probability of 3 Fed rate hikes has increased to 72.5% by the end of 2022, which again would also create some slowdown, which would also help to kind of tame some of that inflation. And this is why, because the amount of excess liquidity in the economy is staggering, which will continue to be a tailwind for inflation. And this is just looking at money supply versus the trend. Is just see how we've gone from that 16 trillion, well over 20 trillion, and how that continues to drive. And that's when you start looking at 38% of investors now think that inflation is permanent, and you're starting to see that fall from those who are calling it transitory. And it's really when you start looking at, well, with the tapering coming, increasing into focus, here's looking at that update in terms of where things are in general. When we start looking at what the backdrops are of the Fed holdings. So you can see that the Fed holdings is almost 30% of the fixed income market. Total Fed holdings of securities, and then that face value. So again, you're seeing just how much is sitting in on the Fed balance sheet. But even with all of this, the 2023 inflation projections still remain low. It comes down to, again, what does the Fed do on the rate side? And that's why this is just going to be an estimate, but it's going to be difficult to really nail down until we learn more of what their Fed expectations are. So looking at all of that, let's go to the S&P CoreLogic Case-Shiller. Record-breaking gains in U.S. home prices have continued with 19.8% annual gain in August for broad-based housing composite, marking the fifth straight month of record one-year trailing gains. However, month-over-month change in rolling one-year performance did decelerate. So it's still up, but not as high as previously expected. And then when you start looking at the Case-Shiller, here's just when you start putting it into perspective, and just when we look back, this is the highest it's been since this chart goes back to the 1980s. So you get an idea of just the pace in which we're going up. And this is just looking at the climb in September. Existing home sales was up 7% as pending home sales dropped. So again, you're seeing some of that bifurcation with things starting to slow down. Again, this is also factoring in seasonal slowdowns. So just something to consider as we look forward. And then in September, new home sales with that increase 14%, largest gain since July 2020 versus the expectations of 2.5%. But the median new home price increase of 18.7% year over year, supply down to 5.7 months versus the 6.5 prior. So again, you're starting to see this is starting to roll over a bit, but again, still a strong way to close out September. And then when you look at the boom looks over, so as you can see, the home prices over $1 million continues to fall. And then different story for home prices in $250,000 to $500,000 range, where sales are negative 23% year over year because they don't exist. So you're seeing the million home sales coming down, and you're seeing a lot of this 500 to 750, 850 numbers, kind of that sweet spot that has maintained some of that growth. And then, based on just what we're seeing overall, this is just, again, keeping those prices elevated, what we've seen in general. But now that we've talked and finished up on the U.S., we really want to turn over and look at what is happening in Europe on growth and inflation, and what does that mean as we go through the rest of the year.